Good evening, everyone, and a warm welcome to the webinar. My name is Neeraj Kodian, and I'll be the moderator for today's webinar. First, let me thank you all for taking out time on this Friday evening and joining us for this session. I would request everyone to use their headphones for better audio clarity. The session will have approx 30 to 45 minutes of presentation and followed by Q&A. You all can post your questions in the chat box once the presentation is over. As you all know, the topic for today's session is small caps, big opportunities, navigating obstacles. Small cap investments offer growth potential, but they also come with their fair share of challenges. Hence, today our speaker will share the key insights on understanding the obstacles and uncertainties faced by small cap mutual fund investors, implementing strategies to mitigate risk associated with small cap mutual funds, identifying potential opportunities in small cap mutual fund space. So before I hand over the control to our speaker, let me introduce them to you all. Our first speaker for today's evening is our CIO, Mr. Chirag Mehta, who has over 19 years of experience in the financial markets. He specializes in the field of alternative investment strategies. Chirag is a qualified chartered alternative investment analyst and has also completed his master's in management studies in finance. He currently manages quantum small cap fund, quantum gold savings fund, quantum equity fund of funds, quantum multi-asset fund, and quantum ESG best-in-class strategy fund. Chirag was named amongst the top 40 fund managers globally under the age of 40 by Citywire UK in 2017. Our second speaker is Mrs. Abhilasha Satale, who has over 18 years of experience in Indian capital market as an analyst and senior research manager on sell side and buy side. Abhilasha joined Quantum AMC in June 2020. Currently, she is an associate fund manager for our Quantum Small Cap Fund. She holds MBA degree in finance from Walchand Institute of Technology. So without taking much time of yours, we'll request our speaker to take ahead the session. Chirag, over to you.
Thank you, Neeraj, and thank you all the investors for joining us today. I know there's been much going on in the small cap space, and you would have witnessed many regulatory interventions, some announcement from fund houses, and of course, the test on liquidity, the stress test as they call it. So we will take you through in terms of what these stress tests were all about, what it means for you as an investor, how you can navigate these obstacles, and most importantly, how are we navigating and building the portfolio for you in the small cap space? Because there are indeed opportunities, as we have suggested before, that this remains one of the biggest opportunity set given the large universe that exists in small cap space. But you need to treat with caution when you're trying to look at opportunities in this space. So I'll run through a few slides which kind of tell you more about the small cap obstacles, the stress test, liquidity issues, etc. And then my colleague Abhilasha will take you through how we are building portfolio and what are the opportunities in terms of themes that we are seeing in the small cap space. So these were the headlines. I'm sure you would have not missed many of these because these were all over the business dailies, like mutual funds told to report by the regulator SEBI to look at liquidity in more detail and come up with a stress test as prescribed by a measure from AMFI. Overall, even we as a small cap fund had to do our stress test, and we have come out with flying colors in terms of liquidity threshold being at 1 day. We can liquidate our entire portfolios in 1 day. And it's not an afterthought that we had built in these liquidity filters right since we conceptualized the fund. We will see in more details in terms of numbers when we go through them. But what are these stress tests all about? So if you see, the small cap fund space has grown significantly over the last couple of years. There have been flows that have been attracted to small cap funds given the performance in this segment. And given the large size of many of these funds and in aggregate overall in the small cap space, what would happen when there is a market sell-off? Will investors get the liquidity of the funds they are invested in will the fund houses be able to sell and raise money for giving it to investors for their redemptions? And therefore, there was a measure in which the SEBI said, how quickly can you liquidate 50% and 25% of your portfolios and disclose that to investors so that investors know how many days would it take and are they taking over risk when those 50 and 25% numbers come out, and and investors can take a call for themselves whether they are okay with that kind of liquidity or they think that that's a risk that they are taking within that small cap funds that they are invested into. So these are various funds that came out with liquidity, and these are the largest funds out there in the small cap space. This was the result of the recent stress test that we saw, and numbers were not that alarming as they should have been. They were around that 20, 40, 50 days kind of liquidity, even at the 50% portfolio level. Of course, for the quantum small cap fund, it was 1 day. But were these stress tests giving you the entire picture? The way the stress tests were mandated was that you kind of remove the 20% of all the illiquid names or stocks that you have in the portfolio and then run the stress test with 30% participation. So it could be that 20% of the portfolio which is highly illiquid does not come into calculations at all, and therefore the numbers that we saw were not that alarming as that they would have otherwise been. So this 20%, say you are an investor in a small cap fund, and 20% of that portion of that portfolio is say illiquid. And when, see, if the fund house faces a redemption pressure, and that's to the tune of say 20, 30%, and they sell all the large cap cash, utilize the cash and sell whatever is liquid in the small cap space to meet that 20, 30% of redemption, then that 20% of portfolio which was illiquid becomes a larger portion of the portfolio, and all the remaining investors will have to have that higher portion of illiquidity, which will then come in the stress test subsequently. So, are you as an investor ready to have been a fund that could utilize or not showcase that 20% of illiquidity, which then could become a problem if you are a remaining investor in the fund? This kind of takes into consideration that everyone near the door will run away as the music stops. But that is a big problem in the making, because you as an investor can get stuck with a large portion of the portfolio that is illiquid, and therefore you need to consider the entire portfolio liquidity and not remove that 20% illiquidity. So in some sense, the stress test give you some picture, but also hides some portion which you may not be comfortable with if those numbers become very, very apparent. So in some sense, it's a great move by the regulator to start something like a stress test, but I think it should not exclude any portion of the portfolio, because that is where the problems could lay, and therefore you may be unaware of the problem. So I think it should be 25, 50, and also the 100% liquidity that the fund house should showcase. And even in that case, Quantum's liquidity profile would not change. Even at 25%, at 50%, and even at the 100% mark, our portfolio liquidity is always is going to be one day even now. And even at a larger size, it will not dramatically change, because we have put in a liquidity threshold into our metrics before before a stock can come into the fund portfolio, and therefore we will ensure that the portfolio remains liquid at all times. So takeaway for investors, that the notion that a large fund can, with large AUM, can face liquidity issues, or if you're a remaining investor in the fund, after they face some sort of redemption pressure, that could blow in the face in terms of liquidity if there is that scenario panning out. So you need to be aware that a fund or a mandate has a capacity, and any AUM beyond that capacity becomes a risk and also could lead to problems like style drift and changed portfolio characteristics. We'll come to these things as we go into subsequent slide in more detail. So if you are considering investing in the small cap space, or if you are an investor already in the small cap space, you should be aware and you should be asking the fund managers what is their fund capacity, and whether, in terms of liquidity pressure, how are they going to manage those, because if the fund size is cross the capacity level, then probably there could be liquidity problems which can remain unaddressed, given you as an investor are not aware of that 20% of the illiquid portion of the portfolio. So this is what we were talking about when it comes to style drift, right? If you see, most funds at increased level of AUMs have seen increase in number of stocks in the portfolio. So if you see, from as it moves from 5,000 crores, for example, the fund A at 5,000 crores, it held 52 stocks in the portfolio. At 10,000 crores, they had 74 stocks in the portfolio. And at 15,000 crores, they held 92 stocks in the portfolio. And look at Fund D, even at 5,000 crores, were 89 stocks in the portfolio. And at 45,000 crores, they have 205 stocks in the portfolio. So as AUMs have increased, the number of stocks in the portfolio have increased. So in some way, what you saw as a more concentrated portfolio has become very, very diversified, a low conviction portfolio with suboptimal holdings in the portfolio. So you as an investor in these funds need to decide, are you okay with the style drift that you're seeing from being a good, well-managed, concentrated, high conviction portfolio to a very, very diversified index-like portfolio, and paying an active manager's management fee for something that is looking like an index incrementally as the size is increasing going. So the if you see the last two rows in the table that tell you that, what were the number of stocks. Of course, funds, we all know that fund sizes have grown in the interim period from 2019 to 2023. But if you see, the number of stocks in each portfolio have gone up many-fold when it was at a lower threshold of AUM to now when they are a higher threshold of AUM. Also, if you see, there are 27 funds in the small cap space now, and the average AUM, so total AUM of small cap space divided by 27 is about 9,000 crores average AUM. And number of stocks in portfolio on an average is about 81 stocks. And number of stocks with less than 1% weight, if you see the column on the fourth column in the second table, is very, very alarming. Number of stocks with 1% less than 1% weight is 71%, 50%, 60%, even 92%. So that makes it very suboptimal weights, weights that do not depict conviction. So if the fund manager is doing hard research and they are trying to find out good quality stocks, then why not to show that conviction in terms of holdings of those stocks, and why to have suboptimal weights like 17%, 90% of the portfolio made up with stocks that are less than 1% weight. So they are diluting the portfolio, becoming very, very over diversified like an index, and you end up paying an active management fee for something that's looking like an index. Also, if you see, we have taken the top 10 as a proxy in terms of the portfolio. So what we saw, even in the top 10, which seems to be, which should ideally be conviction bets of the fund houses, their number of stocks in the top 10 or percentage of stocks in the top 10 that will take more than 66 days. 66 days is kind of a good time period acknowledged globally. That is a good time frame for funds to enter and exit a stock. Here, if you see a percentage of top 10 that takes more than 66 days to liquidate, that is 3 months, is 50%, 70%. 75%. Some funds have lesser number of that liquid lesser liquidity issue. If you see fund E and fund F taking 19%, 19% is illiquid in the top 10 or 8% illiquid in the top 10. But if you move to the right hand table, that is right hand column, that is because they have a large portion of the stocks in large and mid. So what we are seeing, even in the top 10, either they have a liquidity issue or they are moving away from the mandate. In a small cap fund, at least the top 10 should be mostly the small cap names. But if in the top 10, if 50% of the stocks are large and mid, then you're deviating away from the mandate that you have of investing in small cap stocks. So either you have a liquidity problem, or either you have a mandate problem that is deviating away from the mandate of small cap and being into large and mid cap. And also within the top 10, which should be well studied, well discovered stocks, looking at liquidity in a more larger way. Here also, if you see many stocks in the top 10 that will take time to liquidate is 300, 180, 160. So a large number of days. So there is an element of illiquidity in some of the positions in the top 10 as well. So on an aggregate, they have either liquidity problem or a mandate problem, and also there are some portions which are extremely illiquid in the top 10 as well. Also, what we have seen is, what has happened is fund house has a lower allocation of their portfolio to many stocks, but they end up owning a large portion of the market cap of a company. So they are big owners of that company, 7, 8%, 9% even, but that those stocks are extremely illiquid even today. So there is a fund which owns company A. They own about 1.19%, 1.2%, rounding out in of their portfolio, but they own close to 8% of the company's market cap, and it will take 3,000 plus days to liquidate that holding. So imagine a situation where a large owner in a company is trying to sell an already illiquid stock. What would happen to the stock price in that instance? Probably it will collapse. So you have that, they are large owners in these companies, and many of these stocks are very, very illiquid. And in case of a sell-off, I mean, they would not find enough buyers for such large ownership in that company, and probably the stock price will take a toll. So if you are invested in funds which have such concentrated positions of the market cap of a company, then probably you need to be aware of the liquidity issues that you could face in those funds. And also, if you see the current recent trend, right? If you see the sell-off that we saw in small caps recently, uh, it is where there were many large funds that saw lower fall as compared to many of the smaller funds in the small cap space. And that is because these large funds have very concentrated position in of a company's market cap. They own 8, 9, 10% of the company, and the free float in those stocks is very little. The promoter ownership is close to 75%. These funds own about 10% of the market cap of the company. So the free float available is about 10, 15%. And in such instances, if there are no large sellers, probably those stocks may fall lesser, and therefore these funds may showcase a better performance even in a falling market. That hides the fact that they have not received much redemptions, and at the same time they have not gone out to sell those stocks because of no redemption pressure. And in that instance, you are not really seeing the impact it would face in case they see redemptions and therefore they had to sell a stock. So don't look at the current decline that we saw in the small cap space as an example, or extrapolate that to a stress scenario, because that was not a stress scenario, as there were not much redemptions. The aggregate redemption in the small cap space in the month of March was less than 100 crores. So overall, it has not led to a big redemption pressure, and therefore the need for these funds to go out and sell was not existent, and therefore you didn't see a meltdown which could have occurred otherwise. So overall, all these things have been well thought when we conceptualized the fund. It was not an afterthought. We always communicated and told you all that we have a capacity threshold, and whenever we reach that capacity, we'll restrict the fund to new subscriptions. We will close the fund for new subscriptions. And this capacity is derived by what is the liquidity threshold that we have, which drives the from the overall liquidity of the underlying portfolio holdings, we can arrive what is the maximum threshold capacity that we can go to. As per the current liquidity, current portfolio, the fund can has a capacity of close to 5,000 crores. And so whenever we reach that threshold, we will close the fund to new subscription. So we are also mindful of liquidity. We have set liquidity thresholds right in our off documents that we will not buy any fund which has less than 2 crores of average liquidity over the last 12 months. And we want, at any given point in time, we monitor the portfolio liquidity on a continuous basis. We want our portfolio to be liquid in 66 trading days. Portfolio positioning, of course, we have guardrails around portfolio positioning. Uh, the minimum that we want to buy into any stock is 2% at cost, and maximum that we want to buy is 4% at cost. So at any point in time, we have these guardrails that allow us to take an active call on that stock that we are buying, but at the same time, from a risk management standpoint, don't significantly get exposed to any stock. So 2 and 4% is a good balance between the reward that we are trying to reap in that stock versus the risk that we face in that stock. Also from a portfolio positioning perspective, we want to restrict our exposure to 5% of the market cap of any company that we invest into. So we have seen in the previous table, there are funds that have gone to 7, 8, 9%, but at any point in time, at any scale of our portfolio, we don't want to exceed that more than 5% of the market cap of any company. Investment guardrails, I have already spoken about. 2 to 4% on a cost to NAV basis is the investment guardrail. That is a good balance between risk and reward that we are trying to bring to the portfolio. And portfolio action rebalancing. Say, in case, in an instance, though we have a liquidity threshold, our portfolio holdings are liquid, but you don't know in a scenario where liquidity really dries up. We haven't seen over the last couple of years. We have seen only liquidity increase because there were a lot many flows coming into the small cap space. But if you look at in case there is a large redemption that we face and we have to prioritize selling, or some portion of it is not saleable to the extent that we want on a pro rata basis, then probably we will take a call to trim positions with limited upside in the first instance. And post that, if we are not able to sell the illiquid portion, if any, then we will rebalance the portfolio and achieve the optimal weights of those stocks within 1 month's time. So much of this that I told you about is not an afterthought. We have put it as a part of our process. Much of it is defined in the offer document as well, which you will not find with most of the peer funds out there. So there are unique features that we bring to the table when it comes to the small cap space. I think this is a must-have in the strategy that you're looking in the small cap space. Liquidity and market cap are very important considerations. So these allow you to define a fund capacity and to be disciplined about the fund capacity to ensure that the large size of the fund does not become a hindrance to performance or liquidity that the funds are investors are investing into. We think we have strong research capabilities to navigate the large small cap universe. We will look at from a research perspective, what are the themes that we are looking which are looking attractive at this point in time, and that will tell you more about the depth of research that we go into. We emphasis on governance and management quality is paramount for us. We will not buy, like you have seen for the large cap funds that we have, the long-term equity value fund or the ESG fund, governance is very, very important and non-negotiable aspect of our investing. We will stick to that even in the small cap space, and in small cap space, we think it's even more important because you may get these small cap stocks are very fast growing businesses. They may have great order books, but if the governance and management quality is poor, they may not be able to firstly execute, or there could be ways where you don't reap rewards of the profit pool that the business generates because of governance and management quality issues. There could be related party transactions, some siphoning happening from one in one shape or other. So you need to be very clear in terms of the governance and managements that you can trust and invest in only those kind of businesses. Uh, of course, in the small cap space, you have very fast growing businesses. You need to chase those uh, fast growing businesses and ideas, but we need to be prudent about the valuation we end up paying, because if the business may be fast growing but may all be in the price, if there is no upside to that stock, then there is nothing for us as investors to benefit out of. And hence we look at those growth ideas for sure, but at the same time we are cognizant of the fact in terms of valuations that we end up paying for those businesses, and we kind of have a long-term patient approach to capitalize on the compounding that these small cap businesses can bring if you're in the right space. Uh, so with that, I will turn it over to Abhilasha to run you in terms of what potential that we are seeing in the small cap space and how you as investors can benefit from investing in small cap space, and especially with the ideation that we have at Quantum. So with that, over to you, Abhilasha. Thank you.
Thank you, Chirag. Welcome, investors. So this is how small cap space has evolved or has grown over a period of time. So this slide says that the largest small cap stock in 2007 was around 3,000 crores of market cap. Whereas the market capacity has increased, more stocks were added in the space, and the overall, the now when we see the largest small cap stock in the universe, it is around 26,000 crores of market cap. So the companies which are above 1,000 crores, 3,000 crores. So these that space has also increased, and that offers us opportunity to so that widens our the opportunity space for the investment. Next. So this is overall how to navigate, or how the small cap space is actually. So usually small cap companies are very under researched. There are very few broking houses, those who cover these companies. So amongst around say 32 broking houses, only 8 broking houses have the research base on the small cap. At the same time, because as you know, most of the market cap are small, and there are liquidity constraints. So these companies are also under-owned. But then it offers also the mispriced opportunity within that segment, because if everything is known, then there is a very less room for actually, innovating something new. So because this space is under research and under-owned, there are mispriced opportunities in this space. Most of the leaders, like we have seen too many companies graduating from small cap to mid caps and mid caps to large caps. So this space offers a room for creating, larger pool of the larger pool of investments over a period of time. And also the investment returns are to be made are much larger than what we find, the good price opportunities in the large cap. So this room offers a lot of innovation, and if we navigate through the entire space judiciously and able to find good opportunities at right place, and this is a space which gives the maximum returns over a period of time. Next. As a at quantum small cap, so we have build our portfolio taking into consideration all these aspects. Although small cap is a space which has delivered a good amount of returns in the past 3 to 5 years, if we see, in fact over a decade, but we still feel as the opportunity size is so large, and there are different themes which are likely to evolve within India as a country. These are some of the themes which we feel that could contribute to the Indian growth over a period of time, and the companies which are catering to these themes will be the major beneficiaries. So, like we as a fund house, we are exposed to these themes, and we will discuss these themes one by one. So, I think. So financial inclusion is a very big theme which we feel that India is, India will have. India is a beneficiary as because PM's Jan Dhan program has almost 90% of the population is now having digital IDs. Now they are actually coming into that formalization net, and the bottom of pyramid, now they are getting used to the formal credit. So this is a very big trend which is happening in India, and we feel that this will continue over a longer period of time, because that population is very large in India, and as they graduate in terms of their income pyramid, that will benefit some of the financial institutions which are catering to these kind of companies. So we are bullish on, say, small finance bank in this space. Secondly, we have also seen how the broking demat accounts have increased over a period of time. So pre-COVID to this to 2024, if we see, demat accounts have almost quadrupled. So that's a massive jump which has happened. So that is also because of the digitization which is taking place in the country, and some of the formalization of credit, if we see. So I think the companies which are catering to these kind of themes, like broking, MF distributions, AMC companies. So these will be the major beneficiaries. Payment gateways. These will be the major beneficiaries, as this theme is likely to last long over a longer period of time. So Quantum, as a fund house, we have an exposure of around 21% to these themes. In this, major exposure would be towards a BFSI segment, because as we see that as the formalization of credit takes place, because from our data, we see that disbursements to bottom of pyramids have increased at 30% CAGR, as against a normal credit growth of 15% CAGR. So this trend, if it continues, then these banks, or the banks catering to these kind of companies, NBFCs catering to these kind of bottom of pyramid customers, will be the beneficiaries. Apart from that, we also have exposure to AMCs, or some of the other companies which are beneficiaries of this theme. Yeah, so we speak about ICE to EVs. So in that, the major sectors which fall are automobiles, auto ancillaries, and industrials. Herein, we feel auto ancillaries would be the major beneficiary. So within ICE to EVs, there are few other themes also which are working on. So we are seeing the premiumization taking place in India. We have seen most the SUV growth has accelerated. Even the premium bike growth is much faster than the entry level bike growth. So that is largely because the increasing per capita consumption, or the increasing awareness amongst the Indian consumer. So even if we see, EV penetration is improving in India, although at a gradual pace. So by 2030, at least two-wheeler entire will be EVs. In PVs, it is expected that around 20% of the PVs will be EVs. We feel the companies which are catering to these kind of trends will have a better bill of material with their OEMs. So the OEMs are the one which are automobile manufacturers, and that is that will drive the growth for them, not only on the top line as well as on the margin expansion, because if the bill of material increases, then there is an operating leverage which also kicks in over a period of time. And again, India is a is also looked as a export hub. So, it is also looked as a low cost manufacturing hub. So the companies which are catering to those kind of themes, I think those will be beneficiaries. And quantum, we as a fund house, we in this scheme, we are having around 9% exposure to this thought process, or this mega trend. So this part is, so capex is something which is the capital goods, or this that has given the maximum return in the past the 3 to 4 years, and in that everything is included, the railways or defense or power, anything which you see capex related, and that has given multiple returns in the past year. But amongst that, we feel that power distribution is one theme which is very which has a potential to grow. Even we find, some of the companies offer good, are trading at a good valuation. So we have built an exposure in this theme. So here the main, the sectors which are benefited are power equipment manufacturers, smart meter manufacturers, as well as cable manufacturers, because India will have is likely to have renewable capacity setup, around 350 gigawatt by 2030. So to support this kind of investment, India has to have distribution capex. So we have seen transmission line capacity almost doubling in last 4 years, or PGCIL capex, which was almost stagnant for the last decade. Now that is taking a leap, and that is likely to double over next 3 to 4 years. So this sector is coming out of consolidation, out of very long-term consolidation. So therefore, what has happened in because there was lackluster demand for almost a decade, and now demand has improved, many of the weak hands have gone out of the system. So there has been a consolidation in this segment, and which we feel that whoever the players which are remained in this segment will be the major beneficiaries. So so therefore we have built a exposure to this segment. Also, there are export opportunities as we speak. There are companies which are getting beneficiaries of export. So in this week, I'll just mention the smart meter manufacturer, because this we, as of now, we were not having any formal meters, or the meters were not as efficient. But with the recent government's initiatives, government has already tendered around 5 crores of smart meters, and the likely tendering which is going to happen over next 3 to 4 years is around 25 crores. So that's a massive opportunity which is coming into the smart meter, and this is to support the entire capex which is happening in T&D. So basically, government has a mandate to reduce this T&D losses, and that is likely to benefit these kind of players. So so therefore, quantum as a, we have built an exposure of around 6.5% or so to this scheme, which we feel, there are a long-term growth drivers to this theme. So increasing per capita consumption, though, so this is talked many a times, but we feel that now India is at a that position wherein we have already crossed that 2,000 per dollar per capita consumption, $2,000 per capita consumption, and we in the past, whoever country have crossed that kind of per capita consumption, there the consumption, or the growth has accelerated substantially. So we feel India is now in that position wherein the growth is likely to accelerate much faster, and the segments which are likely to benefit from this trend are likely the consumer durables, healthcare, travel and tourism. So durables, as we all know, still India has less penetration. Many of the products we are much less penetrated as compared to developed worlds, or even the developing countries. But over a period, as per capita consumption increases, we feel that this durable penetration is likely to increase and India will be the beneficiary. So the companies which are in that space will be the beneficiary. Secondly, healthcare is again, this is one space wherein India is still very, very unorganized and the penetration levels are still very poor. But as the insurance penetration is increasing and the healthcare facility itself are improving, the reach is improving, we think that this segment is likely to likely to grow over a longer period of time. And therefore, we have taken some exposure to healthcare facilities also. Secondly, travel, we have seen post-COVID has increased substantially. So we have seen, there was a almost like hockey stick growth in the travel and tourism. We have seen utilization levels for hotels and this airline companies increasing. But still, like if we see 3 to 4 years CAGR, we are barely, matching that nominal GDP growth rate kind of this thing. So now we have reached to that normalized growth rate. From here on, we feel that the growth will continue because there's factors like the per capita consumption growth and increasing awareness. Even foreign travels is now increasing in India. So these are some of the factors which we feel that this will accelerate growth or will maintain growth in these kind of segments, and therefore we have taken exposure around 11% exposure to this theme. So the next is like global outsourcing. So India has, we have seen, post-COVID, this has accelerated. So services, India was always known as a low-cost producer, and India has, grown. So we have seen the export of services has grown, and even at the current India has one of the largest young population, working age population, which is likely to remain, which is likely to continue. So, China has already peaked, and most of the developed countries, if we see, they have almost peaked in their working age population increase. However, India, we are in that sweet spot wherein our working age population will support the growth, and India has a potential to become a global manufacturing hub. Now, as we have seen, so for services, as digitization increase and AI penetration increases, we have built some exposure to the information technology companies, wherein those will be the beneficiaries, or they are focused on the current trend which is happening in the global market. Apart from that, pharma and chemicals are these two segments are there, wherein we feel that China plus one is working, and this global outsourcing will benefit India because India has emerged as a low-cost production house. Now the vendors are looking at China plus one post-COVID, whatever we have seen, and therefore the companies which are catering, which have capability to match those kind of cost with China, they will be the beneficiary. So as of now, we have in this team, we have more exposure towards IT, information technology, but we are seeing that the valuations are becoming attractive in this space for pharma and chemicals as well. And therefore, we are increasing our exposure in that theme. So these are some of the themes which we feel are, have a long-term potential to grow in India, and the companies which are operating in that will be the beneficiary. So this is our overall portfolio snapshot. So if we, as we mentioned, financials is around 21%, industrial is around 21%. So these are some of the segments, IT is around 10%. So these are some of the segments which we feel have a better potential to grow over a period of time. Therefore, we have taken, and the valuations are reasonable. So we have, while building the portfolio, we have remained very judicious in terms of the valuation because, as I said, the small cap has performed much more. So there were few pockets wherein the valuations were ahead of the fundamental. So there we have stayed away, and we have built it judiciously, wherein we feel that the growth is reasonable, the growth is sustainable, and the valuations are reasonable. So that has been our approach. And as I said, we hold some cash because we feel that the market will throw opportunities over a period of time. And to grab those kind of opportunities, we are holding a cash. Similarly, wherever now we are feeling the valuations are expensive, at some point of time, if market corrects and all, those will be the opportunities which will be available at a reasonable price. So to grab on those kind of opportunities, we are holding some cash. So this is a very important, these are the portfolio characteristics. So this slide speaks everything about the how it is built. So, and I think that this speaks like what I'm saying in the numbers. So our PE, if we see even the current PE, if we see, as I said, that our exposure to very highly valued companies is less. So our TTM PE is less than the benchmark PE. So benchmark PE is around 30 times, whereas we are at around 26 times. 1 year forward PE, it's 19 times, and benchmark is around 26 times. So that says that our EPS growth is higher than the benchmark EPS growth, so earnings growth. So when we look at the company, we see that, the earning is moving faster and the valuations are reasonable. So therefore, when I invest, I get the benefit of earnings growth as well as the PE re-rating. So my returns will be better than the benchmark. So this is what we have built, and that is seen in the portfolio characteristics. At the same time, we have a dividend yield which is better than the benchmark, so at 1.2%. And PEG, that is price earning growth, because our companies are growing faster than the benchmark companies, and the PE is lesser than the benchmark. So our PEG is much better at 0.89 versus benchmark at 2.14. And this is a final word, just to conclude whatever the current scenario is in the small cap. So there are concerns in small cap towards overvaluation in some of the pockets, and liquidity pressures, the fund becoming much larger than their capacity and all. However, we feel that the space is very wide, and if any correction, if any uncertainty offers any correction, the small cap offers much more opportunities as compared to any other space in the current market. And long-term story for the Indian economy, or where India is placed in the global market, that remains intact. So therefore, the themes which are likely to remain over a longer period of time and grow over a period of time, if one builds a judicious exposure to those themes at reasonable price, then we feel that this is a space which can continue to deliver much better returns for the investors over a longer period of time. So I think that's almost like concluding, and we are open to questions now. Thank you.
Thank you, Chirag and Abhilasha, for the insightful presentation. We'll request all our listeners to post their questions in the chat box. In the meantime, we have already received a few questions via email before the webinar. So I'll start with that. Chirag, first question to you. Do you have any specific plan to safeguard the interest of investors at the time of a big correction, say like 20%, arising due to geopolitical situation?
So when it comes to investing, right, we have always prescribed an asset allocation approach. So the emergency corpus that we have said always of a 12-month emergency corpus or a 24-month emergency corpus kind of takes care of that unforeseen events, right? Something that surprises you, and therefore at the portfolio level, at the overall wealth level, you are pretty okay even if those things materializes. So you always have to firstly start with asset allocation, and you do not have to worry. But when it comes to equity portfolio construction, right, we do our homework, we do a deep dive into those stocks, we kind of find the potential. And if we find the potential that's available at a reasonable valuation, we'll go ahead and buy it. So if there are opportunities, we will stay invested. If there are no opportunities, we may have some cash. Like in today's instance, in the small cap fund, we do have some cash because we are looking for opportunities, but not many opportunities are available which are reasonable in nature and giving us an upside potential to translate for return to investors. So from when it comes to portfolio construction, I think this is the approach that we have. But overall, we have always recommended investors to follow the 12-20-80 asset allocation strategy, which kind of helps you safeguard even if there is a global financial crisis, a geopolitical crisis, or a COVID kind of crisis. So that this is time tested. This has worked well in most of the scenarios. And if you build like with a 12 months emergency corpus, kept very, very safe. And thereafter, any money you have, you kind of split into 80% equities, 20% into gold, and let the fund manager kind of, run each mandates that you give to be in equities or to be in gold or to keep money very, very safe, be it in liquid fund. Once you have that asset allocation strategy, I think it's you need not worry about these exigencies that may occur at any point in time, which may be out of which cannot be forecasted by many of us out here. So it's better to have an asset allocation strategy in place, and you will not have to worry of these events.
Thanks, Chirag. Next question is, even after the categorization mandated by SEBI, I find that many of, or should I say almost all small cap are not true to the label. I say this is because they don't have 65% minimum in small cap stocks. Why is this case? And are they even allowed to have a lower than stipulated allocation to small caps?
The funds cannot own less than 65% if there are small cap equity funds. They cannot own more less than 65% into small caps. They have to have at all points in time a 65% allocation to small caps. So the way regulations work, right? So if I as a fund manager say have 65% into small caps, but because of large amount of funds that I have received, if that threshold goes below that 65%, then the fund manager has 1 month time maximum to rebalance the portfolio and bring it above 65%. So I don't think any fund manager can actively breach that 65% threshold because that will be a breach of regulations. They have to, as a mandate, they have to have minimum 65% allocation to equities. So in a one-off month, probably some fund may have gone below that threshold. But we ensure at all points in time, we are above that threshold of minimum 65%. So current allocation for us into small caps is above 70%. And we will at all points in time, we will want to have more allocation, but at the right opportunities that are available at a reasonable valuation, we will go ahead and raise our small cap holdings into them. We are looking, always scouting for opportunities. Whenever we see them, we'll increase that allocation. But to give you that answer, no fund can have that below 65% as a mandate because that will be breach of regulations. That's not permitted.
Thank you. Next question, with current global political volatility like war situations and attacks looming large now between Israel and Iran, both being nuclear powerhouse, is the world expecting trouble? Can we expect market volatility and corrections or even crash? In such case, it's obvious small cap will be more affected and fall heavily like we saw in 2008, like 82%.
See, Middle East has always remained a geopolitical bedrock, right? There have been many instances in the past as well that have led to disruptions and risk aversion because of those events. Even this time, we have seen that flare up again between Israel and Iran happening. We don't know how it will shape up, how it will kind of impact. But we have seen that over a period of time, many of these geopolitical events, like what we saw with Russia-Ukraine war, kind of remain restricted to some region. It does not develop into a global kind of involvement, and therefore they have subsided or remained restricted over a period of time. But if there is a flare up, for sure, there could be impact on flows, there could be impact and therefore resulting impact on risk assets. And if they sell off, probably it will give us an opportunity to deploy further capital because, probably because of those events happening in Middle East, It may have some impact on certain companies. It may lead to a increase in price of oil. It may lead to some disruption in terms of the exports that India does. So we'll have to ensure that we kind of are on top of these sensitivities into many stocks that we own. But barring that, there could be a short-term impact, and we will be looking for attractive opportunities that may not be hindered by these events in a larger way from the business perspective. And therefore, we will be buyers into those stocks at those times. So there can be events which are unpredictable, which can flare up. There will be risk aversion, but probably we will do our homework and we will be buying into those events if that gives us an opportunity to buy stocks at much cheaper levels than they are today.
Chair, there was one connection question with that. So can we expect comparatively less fall in quantum small cap fund downside protection offered by our fund vis-a-vis many other small cap funds, those take high risk?
So decline can come. So a lesser decline in the quantum small cap fund can come from two things, right? We are owning some cash currently, which will lead to a lesser decline if there is any risk aversion happening in Indian markets along with any global events. And second is we have ensured that there is a cushion of safety. There is a valuation comfort into the stocks that we have owned. Like if you see our PE, it's much lesser. We are at 26 times versus market at 29 times. Plus earnings growth that we have of our companies is far superior as compared to so on a forward of that of the index. So on a forward-looking basis, our portfolio is much cheaper. Our PEG is 0.89 versus 2.14 for the BSE 250 index. So in aggregate, on an historical basis or in a forward-looking basis, our portfolio is much cheaper. And given that there is valuation comfort, these stocks may fall lesser in case there is a risk aversion event that happens. So the cash and the valuation comfort should ideally lead to a lesser decline in quantum small cap. But given that our portfolio is far superior in terms of liquidity, if there is a sell-off and funds face redemption pressure, then they will probably sell what is more liquid. And if there is a common ownership between us and them, to that extent, our stocks may fall slightly to that extent only. But it will, even if it falls, it will recover very, very sharply given the valuation comfort and the cash that we own in the fund.
Thanks, Chirag. Abhilasha, next question to you. Could you please let us know whether there is a market capitalization criteria that you would look at when investing in small cap?
So we have liquidity criteria. So as far as liquidity goes, we are comfortable with at least at 1 day liquidity of 2 crores minimum. We look at, so that is our criteria for our investment. And so we have seen most of the times, like even in the stress test, quantum small cap has performed much better than any other large cap. So that is also adhered by the liquidity criteria which we have for our funds. So as of now, our average market cap is in the range of 12 to 13,000 crores. And that is, I feel that it is much better than what actually, some of the funds would be having. Secondly, if on the minimum liquidity, if we see anything above 500 crores is our threshold. So, any stock which is above 500 crores to, which falls in the small cap bucket, that can be a part of our portfolio. But for our internal, our internal criteria, we have much liquid portfolio, even in the current market.
Needed just to add to what Abhilasha said, from a market cap threshold perspective, we have kept the universe pretty large from 400 crores to where the small cap universe starts, which is currently about 26,000 crores, which has increased significantly over. But when we scout for opportunities, we want to keep that universe pretty wide. But at any point in time, we will ensure that our position does not cross more than 5% of the market cap of any company. So that's a risk mitigant we have put in place internally. And at all points of time, we will keep monitoring this and adhere to this threshold so that we don't end up becoming large owners of any company, and therefore that becomes a risk at some point in time.
Thanks, Chirag. Your thoughts on energy sector like solar, wind, green edge, and why the fund has very small allocation?
Sorry, can you repeat that, Neeraj?
Yeah, your thoughts on energy sector and why the fund has very small allocation.
Okay, so within the energy sector, we have, especially in the small cap space, there are ancillary industries, but not many that that are in the energy. So there are utility companies, there are power companies that are available, but much of this, if you see, because of the power demand, etc., moving high, we have seen that there is a lot of traction from a stock perspective, and therefore it's out of the comfort zone from a valuation standpoint. So it's not that we don't cover those stocks. We do cover those companies, but valuation in that space has gone up significantly higher than what we would like to buy it at. But we have some ancillary within that space, like we are trying to play some of the power demand plays like smart meters, etc., which we do have holding. So wherever we have comfort from a valuation standpoint, we do have. Also, if you see within the index also, the energy sector has a very small weight. It's less than 2% weight in the index as well. So there are not many firstly plays available in that space. And at the same time, there are certain ancillary plays to that energy sector doing well, is where we are, or the utility sector doing well, where we have some or the other kind of ownership. For example, this chart that Abhilasha spoke about, we have power equipment manufacturers, we have smart meters kind of positioning in the portfolio.
So this next question, the investors of small cap usually come here for the short-term profit. Are you having any plan to study the psychology of quantum small cap fund investors? Their exit will have a huge impact on long-term investors.
See, we would ideally want investors to look at this space from a longer term perspective, a kind of allocation of their portfolios rather than just looking at short term profits. It's very difficult to kind of guess that behavior, but we will want that a thoughtful investor that comes to quantum will have much longer horizons, and we'll be looking at small cap as an allocation as opposed to just chasing momentum and returns in that small cap space currently. But having said that, we will ensure we have enough guardrails available. Like, for example, we have liquidity criteria inbuilt, which ensures that a portfolio is liquid. So even if the investor moves out, spinning in short-term profits, probably given the portfolio is liquid, there wouldn't be much impact on the other remaining investors in the fund. So we have thresholds like we will not be large owners of a company, our portfolio will be liquid. That all will ensure that because of the redemption proceeds that we need to raise by selling stocks for the investors going out, the remaining investors will be lesser impacted to that extent because we have those criterias inbuilt, and which will not lead to the impact on the NAV of the fund. Or whenever we sell stocks, we will not sell only the liquid names. We will sell wherever the upside potential is lesser, is the strategy that we have. And therefore, there will be lesser impact. Had we sold only the liquid names, then probably whatever the investors have concerns is very correct, that it will lead to impact on remaining investors because they will be stuck with illiquid things in the portfolio, and which may not have that much upside. But our strategy is to sell stocks firstly, which have lesser upside, trim those stocks first, as opposed to trim based on liquidity. And that will ensure that remaining investors in the fund will not be impacted as much. And also for investors who are moving out in a 1 year time frame, have to pay an exit load of 1%. And that also ensures that remaining, we don't really encourage that kind of behavior. And therefore remaining investors will be compensated to that extent because of the investors going out for short-term profits. So I think we have enough guardrails out there which ensures that the remaining investors will not be impacted as much because of the outgoing investors.
Thanks, Chirag. Next question is, with reference to 20% cash weightage in Quantum Small Cap Fund, do you see scope to deploy funds over next 2 to 3 years, given most pockets are seeing rising valuation, relative and absolute? Uh, did you add any large cap name maybe to diversify or superior return profile in medium term?
Yeah, sure. So I think we see enormous opportunities that will come our way to deploy that capital, not to have to wait for 2, 3 years. Probably it will be maybe 2, 3 month kind of time frame. We are always scouting for opportunities. We saw an interim fall very recently in the small cap space. We deployed some bit then. So whenever there is an opportunity, we will grab it with both hands because we are ready with our stock research, and we'll be ready to deploy into names that we like, but at the prices that we want. So I think there will be numerous opportunities. We are waiting for those, and I don't think it will take a longer time to get those because there is good amount of earnings growth in that segment. We have seen some of the sectors not doing well. For example, what Abhilasha spoke about, pharma, chemicals. Looking at that space very, very closely to see if we have opportunities that we can identify at a reasonable valuation. So there will be sector rotation. There will be pockets that will become reasonable where we will deploy capital. And from a large cap perspective, yes, we do have some allocation to large and mid caps, which is about 10 to 12%, not overtly large. Given that we saw certain areas opportunistically that were available with decent upside, and therefore we kind of allocated some capital to help us diversify as well as opportunistically get returns added for investors. So overall, I think we should be judicious. Any opportunities that we get come our way, we will deploy that capital quickly. But if there is no opportunity, we will probably stay until that time in cash.
Thanks, Chirag. Abhilasha, next question to you. Yeah. Small cap fund had a significant allocation to automobile and service sector.
Okay. So, Nee, there was a question about the large cap exposure. So, yeah, we to diversify our risk, we have also built some positions in some of the large caps. So, as of now, large cap forms around 12 to 13% of our overall allocation. But as Chirag mentioned that we would predominantly, deploy most of the funds in the small cap because that is a segment which we feel offers maximum opportunities. So as and when we get the opportunity, we will deploy maximum funds in the small cap. But to diversify our exposure, we also have few large caps. And the sectors are somewhat similar what we have already mentioned.
Thanks, Abhilasha. Abhilasha, next question to you. Like small cap fund has significant allocation to automobile and service sector during last 1 year, but it seems to find the fund seems to facing problem to get returns from this allocation. Can you explain the same?
So we deployed since November. So it's been about 4 or 5 months that we have deployed into that, and probably we are seeing traction in that space as well. So what has happened in the interim is some of the subsidy in the EV space has gone down. That led to some interim halt in terms of EV sales that we have seen. Given elections were near, I think there was no scope to reignite that subsidy or re-evolve that subsidy by the government. So probably post the election, there will be a rethink on providing subsidy. Government seems to remain committed to ensuring that EV is the way to go. So it's not only companies that we have are only catering to EVs. We have companies which have, irrespective of wherever the growth in two-wheeler and four-wheeler comes, these companies supply to both kind of environments, be it ICE combustion engines, or be it EVs, and therefore over a longer period, couple of years down the line, they will tend to benefit of the increased sales in two-wheelers and four-wheelers that will come. So we think that we have good names in the portfolio in that space, in the auto ancillary space, and I think they will benefit as we see more sales of two-wheelers and four-wheelers, be it from the EV front and or be it from the combustion engines front. On the EV front, they will benefit much more as compared to combustion engines, because there is lesser competition on ancillary side, and likes of EV companies are looking for supply chain that are reliable, and these are good quality managements, good companies. They have established themselves pretty well in the segments they operate, and therefore they will tend to benefit of the increased EV sales that will happen over a period of time. So we are very positive on this sector. It's just a few months, it's not like we could judge any performance within 2, 3, 4 months. Hopefully, it will recover and it will start doing well, because we have a valuation comfort. There is a cycle that is in their favor. We think these are good, well placed from a product perspective, good managements to back, and therefore they will tend to do well and recover and give performance over next couple of years.
Thanks, Chirag. Chirag, next question is, your holdings are in range of 2 to 2.5%. So don't you see value in them?
So we do see value in them, but they aren't very, very cheap as well. So we have kind of built our position to the extent we were comfortable. If these correct, we like these names, but if they are available at a better valuation, we will tend to increase our position in those stocks. So position building is based or related to the upside the stock offers. These are high quality names. These are businesses which are growing. They show good potential of growth over next couple of years. But to an extent we are comfortable with the valuations, given the growth in these companies, we have built that kind of position. But if the market were to correct or these stocks were to correct and will be available at a much better valuation, we will want to increase our weight into these stocks. So it is given the circumstances of valuations that prevail, we have built that 2.5% weight into these stocks.
Next question is, suppose you allocate 5% to stock and it increases above 5% of your portfolio, what would be your approach?
So we can have any stock run up to 10% of the market value of the company, but we will ensure that on a cost to NAV basis, we don't exceed 4%. And at the same time, we don't want to be more than 5% of the market cap of any company. So these are the guardrails. Within that, if the stock price keeps increasing, we don't mind that performance. We will not cut our losses or book profits if it does not hit our sell limits. So if it hits our sell limits, we will trim those or sell out of those stocks. But if the earnings keep compounding, we will continue to hold those stocks if there is upside in those stocks, unless and until it reaches any of these thresholds. Either it goes more than 5% of the market cap of a company, which is not going to happen just because of the price performance, because market cap is growing as well. And up to 10%, we don't mind owning that stock if there is an upside story to that stock.
Next question is, your current research team size, and is Quantum Advisor related to Quantum AMC in any way?
So I think you all know that Quantum Advisors is a parent company of Quantum AMC. So Quantum AMC is a 100% wholly owned subsidiary of Quantum Advisors. And overall, at the group level, we have pretty large research teams. So research and investment staff would be upwards of 25 people at Quantum. So there is, we have large research and investment teams, and there is a lot of sharing that happens on in terms of a knowledge base that we all kind of develop. So pretty large research team. That the number I quoted is 25 to 30 people in total, which makes it one of the largest research and investment teams in the country. And the relationship is also I explained. It's like these and not to forget that Quantum Advisors acts as a sponsor for Quantum Mutual Fund.
And the research team size.
I just mentioned research team size overall. Research and investment teams at Quantum as a group is about 25 plus people.
Chirag, next question. Do you use a momentum strategy for small cap?
See, in a small cap, no, we don't use a momentum strategy. What momentum that we are looking for is the earnings growth momentum in stocks that we are looking for. So we don't look at stock price momentum, but we look at stocks to screen out from a large universe. We see where is the earnings growth momentum taking place, which kind of companies are kind of showcasing that their earnings will keep growing year over year, and therefore look at whether to support or be part of that earnings growth, what are the valuations at, and therefore we will take part or build a portfolio with stocks which have that earnings growth going on. At the same time, they're available at a reasonable valuation for us to buy. So we don't look at momentum chasing kind of strategies. We are not that kind of. We are very fundamental bottom up research house that looks at a deep dive into stocks, and we kind of make models of those stocks 2 to 5 year out, but take calls on 2 year out numbers generally, and buy into stocks that offer an upside potential into those stocks. So anywhere where there is a great governance, good governance, great management, upside potential that emanates from the earnings growth story, we will buy into those stocks.
Next question is, what is the average holding period of small cap companies in your portfolio?
So small cap, it's just about 4 months that we have completed since November, then when we launched it. So until now, there has been only one stock there that we have fully exited. So that gives you an example saying that whenever a stock runs up in price and hits our sell, we are very, very disciplined investors, and we will sell them whenever they hit our sell. But unfortunately or fortunately, it's been only one stock in the 4 months time frame that we have seen that hit our sell, and we have completely exited out of that stock from our portfolio.
On average, how long?
But on a general basis, we want to be long-term investors in those stocks. We think our churn ratios will be, it's difficult to estimate because it depends on the market environment in which we operate. If markets really run up, then there will be many stocks that hit our sell, and we may be selling out of those stocks. But otherwise, we will want to own stocks for 3, 4 years, 5 years time frame.
Next question is, on average, how long it takes you to identify and invest in small cap companies?
So in the small cap, I mean, it's a very large universe, right? So within that, we kind of narrow down the universe based on earnings growth, based on growth that we are seeing in that segment, not only historical but forward looking as well. We'll try to look at where is the impetus of growth coming from an economic perspective. And whatever stocks that come, we kind of deep dive, look at capital allocation decisions of companies over time. We look at what valuations they trade at, what is the kind of growth drivers or catalysts for those stocks. And then we will do a deep dive in terms of meeting the management, doing our numbers 5 year out, seeing wherever there is an upside, we will try and build our conviction and then buy into those stocks.
Thanks, Chirag. Next question is, generally, what is the acceptance rejection ratio for small caps versus large mid cap companies?
So there is no such acceptance rejection. Of course, there are certain areas which are completely could be outright rejected if there is bad governance, if the management quality is not good, if the track record is not good. Probably those are the things that we would be wary of and not go into those spaces. But each company, when it is fundamentally driven good business, we will have to study that in detail, arrive at a valuation that's sensible, and therefore a price at which we will want to buy that stock. So, but given the run up that we have seen in small caps, there are issues from a valuation standpoint, and therefore getting good quality companies at a valuation that we like, that will give an upside, is slightly difficult at this point in time. But there isn't a ratio as such in terms of acceptance or rejection. Of course, we have to go through lot many names in the small cap to arrive at final one that will make it to the portfolio, because the universe is so large, right? Even if I look at a meaningful market cap of more than 1,000 crores to about the top of the funnel, which starts at about now 25, 26,000 crores. It's about, and also look at liquidity trades of companies. Still, I see a meaningful universe of about 800, 900 stocks. So it is a pretty large universe as compared to large and mid caps. And therefore, to scout that universe, we have to go through a lot of companies before we say that, this company is a great story uh, in terms of earnings growth, the business perspective, etc., and available at a reasonable valuation. So it takes a lot of effort for sure, but does not mean that the acceptance rate, rejection ratios differ from what we see from a percentage perspective between large and mid and small cap companies.
Out of 25 people in research team, how many will be dedicated for a small cap universe?
So everyone is looking at ideas and sharing ideas that come their way, because when you're looking at a sector, there could be many companies that are even smaller. So even the other strategies that we have, uh, the ESG fund or the long-term equity value fund, they have a liquidity threshold. They are not biased towards large, mid, or small cap companies. They can, if the stock is liquid, they don't mind owning a small cap stock. So as a database, we kind of cover a lot many companies overall at Quantum, and therefore it gives us a good sharing. So it will be difficult to say that the person doing large cap isn't contributing to the small cap space as well. So from a dedicated perspective, it's still a smaller team that operates for small cap. It's about four or five people in total that contribute to small cap dedicatedly. But overall, the database is being contributed by many people, and therefore ideas can emanate even from there, from the sectors that they see traction, or smaller companies benefiting out of something that's policy driven, or be it a new area of growth. So there could be ideas emanating from anywhere. It will be difficult to pinpoint the dedicated contribution that only the small cap team makes to what comes in the portfolio.
Given the research team size, which is quite big, does Quantum EMC feel the need for research from sell side?
So we do get research from sell side, but that's not that we use their research directly. It's if there is a contra view, we like it a lot, because that kind of helps us evaluate our thesis on that company. If we are missing anything, it helps us evaluate that. So from a external sell side perspective, that's a good input that we get. Plus, we use sell side a lot to kind of try and arrange meetings with the managements of companies. So that's been a bigger value add at Quantum, because we do our own research largely. But we also look at sell side reports only from the perspective to get insights that we may have missed. So we like any contra calls than what we have at Quantum coming from sell side, if there are any. It's not that we look forward to their research to get something that we could buy. So we are open to ideas, but it's as I said, it's more to challenge our view on any company and to arrange meetings with managements of companies.
How sacrosanct is the US dollar 2000 per capita income threshold? Don't you think this number would have moved up over years or decades?
So this number has moved up over years, of course. If as you see the chart, the number has come from where it was earlier. But what we are trying to point in that chart is when countries cross that threshold, there is an impetus to growth that occurs. We have seen it for many emerging economies like Malaysia, Thailand, Vietnam, etc., or even China. Uh, that growth kind of leapfrogs from there. There is an acceleration to growth to some extent as that per capita income increases, because and that is the time where we have seen economies move from sustenance to more discretionary spending. So if that were to be true in India's case as well, as we have seen for other economies, then what we are trying to highlight here is that there could be higher consumption or higher demand for more consumer discretionary oriented industries. And therefore, that's one area that you need to watch and keep an eye for. And we are seeing that traction come in the Indian economy as well. Like we have seen a big boost in travel, we have seen increased spending in healthcare, even for consumer durables. So we don't know how lasting that is, or if that will be true in India's case as well. But it has been true in many other economies as an example. And probably we are keeping a close watch whether that would also mean a leapfrog in growth for Indian economy as well or not. So if you see this chart, the black line is the India per capita income, which has grown from very low levels to $2,200 now. And probably that is where, if you see many other economies, had kind of seen some acceleration in growth on per capita incomes. And if incomes increase, probably, if you're moving past sustenance, then probably you are moving into more discretionary spending, and therefore discretionary spending companies that cater to that space will benefit out of that trend.
Next question is, what is your framework to decide when to sell the stock?
So like most funds at Quantum, which does fundamental analysis, whenever we research a stock, there is a sell price to each stock, a target price. And whenever the stock reaches that price, we will quickly reevaluate the stock to see if we have missed anything from an earnings perspective. And if there is no reason to upgrade our earnings on those stocks, we'll be disciplined and we will slowly, gradually sell out of those stocks. So it's nothing but the target price. And at that target price, in our view, there is no upside remaining in that stock. And therefore, it's better to exit those positions. And that is what we do.
Sure, there's a question on gold. How will gold perform in 2024, 2025?
So already we have seen good returns that gold has generated this year, right? And the factors that, the underlying themes that we were seeing earlier seem to be coming to fruition now. One is the Fed probably is in a conundrum where at one end, they have already announced 3 rate cuts, or they have said that probably there will be 3 rate cuts in this year. At the same time, inflation seems to be in a stickier level. And at the same time, I think they are moving to rate cuts, or they have been announcing rate cuts, is because of the high debt levels that prevail in that economy and higher cost of debt that is leading to impact on the US fiscal deficit, and therefore again to the debt levels that US has. So I think sooner or later, given these unsustainable debt levels and increasing cost of debt, is leading the U.S. central bank to consider rate cuts faster than it would have warranted. And probably this could also be an error in policy making, like what we have seen the flip-flops over last couple of years. Firstly, to call inflation transitory, and then to claim victory over inflation. And now, if there is again a flip-flop in where they might not be able to cut as much, or they cut even despite inflation, probably there could be some loss of credibility at the Fed. So overall, we think that these could be bigger drivers and underlying factors for gold over a period of time. If you see the interest payments alone make about 800 to 900 billion dollars in payment made by U.S. government just for interest payments. And if you see until 2030, 35, even the U.S. fiscal deficit is not inching any lower. So they have $1 billion of deficit even going into far out of 10 years from here. So I think it's in a difficult situation where the debt level has at alarming levels, and if deficit does not come down, so that will pile on to further debt that the US will have to issue. And the central banks across the world have been buying, shoring up more gold and building their uh, forex kitty with gold. So I think the underlying drivers remain move away to diversify away from the dollar. And I think there are fundamental reasons to that diversification. Plus, geopolitical conflicts have been helping gold, given the flare up that we've seen recently. So I think gold probably, given these fundamentals, may have run up slightly more in the short term. But I think there could be pullbacks which will be limited in nature, given the strong underlying pinnings that it has. And so short term, there could be mixed. But if it corrects, I think you should add to gold allocation if you don't have enough of the allocation to gold. We say anywhere between 10 and 15% is an ideal allocation that one should have of one's portfolio. So if you don't have enough, probably any pullbacks, you should look at adding more gold to the portfolio, because medium to long term, we think that gold prices will move up.
Chirag, last couple of questions we have. There has been issue of not having enough liquidity in small caps. So how do we find companies where there is enough liquidity to provide us an exit if required?
So liquidity in isolation is not a problem, right? Liquidity in context of the size of the fund that you operate, it really becomes a big problem. So if your fund, the style that you have in terms of selecting stocks, building the portfolio, etc., and given that liquidity of the underlying portfolio can scale up to say 5,000 crores, and if you're running a 10,000 crores fund, that is a time when it starts becoming a big problem for you, because in case of redemption, you don't have enough liquidity because you already surpassed threshold levels to which you can support that liquidity. And in that case, it start becoming a big problem. So if the funds would have held to the capacity of the fund that they could run up to, then there was no problem in the small cap space. But given the flows that we have seen in the small cap space and the funds becoming larger than the mandate capacity of those funds, that is where the issue of liquidity arises. So one needs to be wary. We have been vocal about mandate capacity, like any car that you buy, like say a BMW you buy. If the plant in which the BMW gets manufactured has 1 million capacity, you buy any car within the 1 million capacity, it has the same characteristics, same quality, etc. If the plant were to manufacture anything more than 1 million, then probably you will suspect the quality of that car, right? You won't call up the car company and say, give me 500 car, give me 1,000 car, give me 5,000 car, or give me 50,000 car, right? You think that it is within the capacity, it will have the same quality, and therefore you won't worry about it. Similarly is the fund, be it the first rupee that the fund manager invests, or be it 500 crore rupee or 5,000 crore rupee, it has to be invested in the same way, have the same characteristics, have the same liquidity traits. And if it is not, then the fund managers have moved beyond the capacity that it can operate. And in such instances, you will often see liquidity problems arising, especially when there is an exodus or redemption pressure and a sell-off in markets. So what you thought the profits are on paper may not remain on paper, because this fund manager is trying to sell stock which does not have liquidity, And when you're trying to dump that stock, which does not have enough liquidity in it, enough trading volumes, then the stock price collapses. And what you had profits on paper does not realize into actual profits. So the NAV that you had, you thought it was a transactable NAV, a realizable NAV, but in reality, it was not. And that is the problem that you see in the small cap space of liquidity when the size exceeds that threshold mandate capacity. And as we have announced that our mandate capacity is close to 5,000 crores. If you see many funds in the industry are at 15, 20, 40,000 crores even. So I think if you are investors in those funds, probably you need to ask the fund managers of those funds, what is the capacity of the mandate that you operate and whether there will be a liquidity issue or not. We are very clear of the criteria that we have on liquidity. We are very clear on the mandate capacity that we have for the small cap fund, and therefore we will not run into those problems of liquidity. So if you are invested in any small cap fund and if you cite those liquidity problems, then probably the quantum small caps fund is placed to be, because you will not lose sleep or liquidity of the small cap fund that we operate.
Thanks, Chirag. There is a question on the mandate only. Like when the fund has more capital than opportunities to invest, what would it do with the access fund as it has to meet the mandate on asset allocation as well?
So investing, when you are trying to invest and you have a minimum threshold that you have to meet, which is 65% into small cap companies, the universe is so large that you will be able to scout one or the other reasonably priced opportunities in that space. That is our sense. And that is what we have done so far. Despite relatively higher valuation prevailing in that space, we have been able to manage to scout companies which are available reasonably today and have a good runway of growth. So if you see, our peg is less than 1. So the price that we are paying for the earnings, future earnings, is not that expensive that it warrants that it becomes riskier from a valuation standpoint. And hence you will be able to scout for opportunities. That is our sense, and that is what we will do as a fund manager. So we will keep looking for opportunities, and we will and in case we don't see opportunities and we're not able to meet that threshold, probably it falls for us stopping subscriptions even in that case, because it's a very extreme event. Because there are opportunities that we see which are reasonably priced and we could build the portfolio with. But in that instance also, we will be very, very disciplined, and we will tell investors to not invest at that time, or maybe if needed, stop subscriptions even then. But until we see those opportunities, we will not stop subscriptions. And current cash level is waiting for better opportunities that give us more upside to be converted into returns for investors. So I think if we are within the mandate and if we are doing our job and scouting for ideas, probably we will be able to find at least ideas which are reasonably priced to cover that 65% of the threshold that we are mandated to invest in.
Thank you, Chirag. With this, we will end our Q&A session. Any closing comments from one of you?
So I think just to say that, in the small cap space, you need to be aware there are opportunities, but at the same time, there are risks in that space, given the businesses are new, relatively new rather, and managements are untried. So there is an element of risk. So I think it's a great opportunity, but at the same time, you need to be aware of this risk and therefore craft your allocation to about 10 to 15% to small caps, and not go over looking at the recent performance that small cap has generated over last 1 or 2 years. So you need to be in that space. You need to be crafting your allocation more prudently, and at the same time looking at whether the small cap fund that you're investing into does not bring the additional risk of liquidity, market caps, valuations, etc., and be it a fund that is more prudent, more judicious about how they craft their portfolio. Thank you.
Thank you for a valuable comments. To know more about our 12-20-80 asset allocation solution, we'll request all our listeners to visit our website www.quantumamc.com. Also, further, for any questions to be answered, you can write to us at customercare@quantumamc.com and we'll be happy to answer the same. Once again, thank you all for giving your valuable time. Stay safe and happy investing to you all.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.